Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky with Break of Day Capital. Be sure to join our Facebook group, Asset Management Mastery, where we have a great community of thousands of like-minded individuals sharing resources and best practices. Hey everyone, we have launched the BODC Multifamily Impact Fund. Invest with a trusted operator with a track record of success. Our fund offers diversification, risk mitigation, tax benefits, and stringent acquisition criteria. If you'd like to learn more, head over to our website at breakofdaycapital.com.
Choosing the right insurance coverage for multifamily properties isn't that complicated if you know who to talk to. At the Garzella Group, we're uniquely qualified to help you navigate the range of policy choices you have, and we're committed to saving you 30% in the process. We do intensive market research and have nationwide relationships, so we can find coverage other insurance brokers simply can't. We should talk. Go to quotenow.biz and we'll start the conversation.
Today on the podcast, we have Brandon Hall again from Hall CPA. He's going to talk about year-end tax strategies. This was a webinar that we recorded that I wanted to share because Brandon is a wealth of knowledge and is the rare CPA who is easy to understand. Let's jump in.
So I'm going to run through just a few high-level things, and then I will actually share my screen with a presentation that I have. I'm not going to do the full presentation that I have because it's not totally applicable, but I'll run through some of it. Year-end tax strategies. Well, first off, we just had Republicans sweep Congress and the presidency, right? The executive office. So I think that a lot of what I'm going to say today is obviously a big asterisk of that could all change at any time. I think most likely we will see upcoming tax changes. I think that you will see bonus depreciation be rolled back to 100%. I think that you will see the R&D tax credit come back into play, being able to have the full expensing. I don't think that you'll see SALT limits repealed because it's just too expensive. But it'll be really interesting to kind of see how they expand the various provisions in the 2017 Tax Cuts and Jobs Act. And that's where 100% bonus depreciation lives. And I expect that we'll see some movement on that by Q1 2025 or by the end of Q1 2025. So what does that mean for the end of the year? Well, bonus depreciation is always a big conversation at the end of the year. If you qualify as a real estate professional, which I'll have a couple slides on here in a second that I'll show you. But if you qualify as a real estate professional, or if you're running the short-term rental loophole, then obviously bonus depreciation is very much a friend. I think this year it is 40%. Is that right? It's 60% this year. It's 40% next year, 20% in 2026, and then 0% in 2027, assuming that, of course, it doesn't get extended or retroactively bump back up to 100%. So I would say at the very least, you can count on 60% this year because that is the current law. But I would expect that if they extend the 2017 Tax Cuts and Jobs Act, they will probably retroactively change bonus depreciation to the beginning of 2024. And all of us accountants just hope that that gets done, as soon as early as possible next year, and not like in May of next year after we've already filed thousands of tax returns. So we'll see what's happening there. But my suggestion would be on the topic of bonus depreciation, if you have placed property into service this year, or if you're retroactively running a cost segregation study, because you can do that retroactively. You don't have to do it in the year that you actually acquire and place into service the property. You can do it really at any time. Perhaps wait on getting the cost segregation study performed. So even if you bought a property today and placed it into service tomorrow, I would press pause on getting the actual cost seg study done. The cost seg guys don't like hearing that. They're salespeople. They have year-end targets that they have to hit. So they always send out emails saying you have to do the cost seg study by 12/31 or you lose the benefit, which is not true. They're just trying to sell. They're trying to meet sales targets. You just have to do the cost seg study before you file the return that the cost seg is going to apply to. So 4/15 April 15th next year, or if you file an extension, it's October 15th of next year. So what I'm trying to explain here is from a year-end bonus depreciation perspective, only because we now have this sweep in Congress and the executive office, tax changes will 100% come. The forecast of tax changes is 100%. And the question is just when. So if I bought property this year, placed it into service, I'm going to hold off on getting that cost seg study done because I don't have to pay again for a new cost seg study to rerun it at 100% bonus rather than 60% bonus. So just something to keep in mind. That's a big one. The other things to kind of just clean up before year end is make sure that you substantiate your tax position. Now, what does that mean? That means that if you are a real estate pro, if you are running the short-term rental loophole, that you have a time log. If you are a client of ours, we will not take the position for you unless you present a time log to us. And we will look at that time log and we will challenge you on it to make sure that it's legitimate time that we are basing this tax position off of. We've always operated under that sort of methodology of we won't take that position for you unless you present a time log. Sometimes clients don't like that. They go, well, I want you to just take the position. And we say, yeah, we're not going to do that because real estate professional status, like it's highly litigated and there's audits behind it. And to be honest with you, 2016 to probably November 2023, we were saying that. And even though it's true, there really just weren't that many audits going on. We had three total audits. One of them was our client and two were inbound between 2016 and 2023, November 2023. Starting in December of last year, we've seen audits ramp up drastically. So going from like 2 to 4 a month to now we're at about 8 to 10 a month. Some of this we might have spoken into existence because we've just been talking about audits that are coming down the pipe. And so then we get more requests for help. And to be clear, those like 8 to 10 a month that we're seeing, maybe one of those is one of our clients and the others are just people that are coming from other accountants that can't help them. But these are all real estate professional status audits and they're all short-term rental loophole audits. And there's a lot of issues. We now do a landmine review whenever we're onboarding an audit client. We have seen enough mistakes. I dropped my wedding ring. We have seen enough mistakes that we want to uncover all the compliance mistakes that the prior accountant made, and not let the IRS auditor uncover them, or at least not be surprised when the IRS auditor uncovers them. And then by uncovering the mistakes up front, we can help kind of direct the conversation away from the mistake. So some of these audits, frankly, the taxpayer does not deserve to win, but we are able to direct around the mistake and it's all fine. So that's been going on. But the key is that you have to have a really solid time log. It's the very first thing that the IRS auditors ask for. And it has to be a real representation of what somebody might actually do if they were a real estate professional or running that short-term rental loophole. So full circle, year-end tax strategy is just to beef up your documentation. Make sure that you have a time log if you're a real estate pro or if you are running the short-term rental loophole. And make sure that you document all of your receipts. Now, there's technically a $75 threshold where you don't have to document receipts if it's under $75. We tell clients, ignore that threshold, document every single receipt. It's a little bit more admin work. However, the auditors will just ask for all the receipts, even though that $75 threshold exists. So just document all the receipts. So if you go out to lunch or coffee or dinner with somebody and you're going to write that off as a business meal, get the actual receipt, write down who you met with, at the top, what the purpose of the meeting was. It doesn't have to be like an expansive note, but just a couple quick things. Take a picture of it and upload it to your receipt file and you're good. That's all you have to do. But you do need to be documenting stuff because the IRS what will happen under audit is they will say, well, that was a personal expense. And then you've got nothing to substantiate it. And the auditors, the way that it works is, one, they have to win on something because the auditors are held to realization as their production metric, meaning however many hours I put in, how many dollars did I get back? What is that percentage? And that is their performance evaluation at the end of the year. So they have to win on something and they're going to find things to win on. And if they throw out a bunch of receipts and you're not able to prove otherwise, even if they're less than $75, what's your option? Your option is to go to appeals, which is more expensive. Appeals is going to say, but you don't have any receipts. So then your next option is to go to tax court, which is even more expensive. And then tax court's probably gonna be like, well, you don't have any receipts. So what are we supposed to do? So the IRS is going to win at the end of the day. So just make sure that you document everything, every expense. If you can't document it, there's a high risk that it can get tossed out in an audit, and there's just not much that you're able to do to kind of claw it back and make sure that it gets into the system. So a lot of the year-end stuff is like just kind of understanding the tax landscape and the timing of things. So that bonus depreciation conversation, it could be 60, it could be 100%, just kind of depending on how quickly Congress moves on tax legislation. And then it's really just making sure that our entity structures are all set up correctly going into year end, making sure that we're optimizing retirement accounts going into year end, solo 401ks, self-directed IRAs. If you have those set up, review the contribution guidelines and timelines. If you don't have those set up, set them up and review the contribution timelines and guidelines. And then it's really just the documentation. The documentation is the number one thing. It's not a sexy strategy, but it is a tax strategy. Is just clear documentation, good accounting, good bookkeeping, clear documentation. If I could wave a magic wand and get all of our clients to actually do their bookkeeping on a monthly basis, oh my God, we would like our clients would be way more successful, and we would be way more successful preparing their tax returns. It would be done in a flash. But that's impossible. So it just doesn't happen. Right? And I say it's impossible as a real estate investor myself, who also does not do monthly bookkeeping for my own rental properties. I do a bank export at the end of the year and run a pivot table, and that is my accounting. So I get it. I am one of you, but I also totally understand the back end of that, of just how complicated it makes actual tax preparation, and how much it extends the process. So if you can get your bookkeeping caught up and get in front of it, you will have a lot smoother of a tax season, and you'll be able to catch like mistakes that your preparer is making too. So that's kind of the value of that. So that's sort of like a high level of what do you need to focus on before year end. Now, what I want to do is share a presentation and just kind of go over a few things. I'm not going to go over everything in this presentation, but just a few things. All right. So that's sort of like year-end stuff. But now let's talk about like just a little bit longer term. At the end of the day, we pay a lot in taxes, right? And this is sort of a year-end conversation too, because what happens is we get people, especially this time of year, like our lead intake goes from like, this to at year-end, it goes whoop way up, right? Everybody wants to save money in November and December. And there's urgency and they want to get it done. The problem's twofold. One, you like most accounting firms fill up with client calls, so you can't actually onboard somebody around this time. We're still onboarding people, but we're about to hit peak too. But the other problem is that a lot of the like year end, let me save money today, write off my G wagon, that type of thing, it actually comes back to bite you at some later point. So what I like to talk about is over the span of 5 to 10 years, the goal is to reduce our effective tax rate. That's what tax planning is. That's what tax consulting is, right? If we can hit a home run immediately, we will hit that home run. However, we don't want to lose sight of the fact that long term, the goal is to reduce our effective tax rate. That's the goal. So that long-term kind of messaging is frankly not very sexy, because people come to us, they go, I hate the IRS and I want to save money today. Right. And so, but with that mindset of, I want to save money today, there's a couple things going on. You get some FOMO, because we're all in these like entrepreneur real estate groups where somebody's doing something really cool from a tax perspective. And it's like, oh, I want to do that too. Right. So we've got some built-in FOMO. We just have to recognize that. But that will lead us to take undue risk, unnecessary risk, right? Like investing in some weird trust structures where, the attorney says it eliminates income taxes, which is an abusive trust scheme that is going around right now. And it costs $50,000 to set up. And I promise you, if you pay $50,000 to set up this really sexy trust tax structure that was promised to reduce your taxes, you're not going to listen to anybody that tells you that it doesn't actually work like that, because you already sunk $50,000 in it. It's a sunk cost fallacy, right? But so that's what I mean when I say we have to kind of temper our expectations and our emotions, and we have to look at this very logically and objectively. And the way to do that is to say, I want to reduce my effective tax rate over time. if we can hit a home run today, let's do it. But I'm going to do this over time. I'm going to commit to that. That will lead to a much wealthier position in the span of a decade. So in terms of taxes, we pay a lot in taxes. We pay state taxes, federal income taxes. We also pay FICA taxes. And if you're self-employed, you get the wonderful privilege of paying both halves of FICA taxes. So you pay 15.3% instead of 7.65%. The goal, like I said, is to reduce our effective tax rate. So for this example, and for the next couple of slides, we're going to look at a physician and, sub in any career here. You're earning $500,000 and you pay $225K in total taxes. Now, if you're looking at that and going, well, that's a lot of taxes, this is also including FICA taxes. Okay. So the doctor's effective tax rate is 45% in this example. And what we want to do is we want to, over time, again, the goal is over time, reduce my effective tax rate. We want to build income streams that are tax efficient, such as invest in real estate. Because when we invest in real estate, we might have like $30,000 of income, $20,000 of expenses, and that leads to $10,000 of net operating income or cash flow. And that cash flow might not actually be $10,000 because it depends on how you finance the property, right? But in this example, let's just assume that we paid 100% cash for the property. So $30K in rents, $20K in expenses, $10,000 is my net operating income and my cash flow. But then we get to layer in depreciation. And let's just assume depreciation is $12K. So in this example, I made money, $10,000 of cold hard cash hit my pocket. But then I get to tell the IRS I lost money because $10,000 minus $12,000 of depreciation expense is negative $2,000. So I get to tell the IRS I lost money even though I actually made money. And even if I can't claim that $2,000 tax loss, all right, so let's just assume that it gets suspended and carried forward. What did I just do? I just increased my income by $10,000 and I paid zero additional taxes. So if we actually look at an example and we deploy this to our doctor example, now our physician has earned $510,000 of total income and paid $225K of total taxes. So they've reduced their effective tax rate from 45 to 44.1%. And that might not be that exciting. However, if you do this 20 times, which you can absolutely do that over the span of a decade, now you have an extra $200,000 of cash flow that you're not paying tax on. So you've earned $700,000. You paid the same $225K in taxes and you get a 32.1% effective tax rate. That is tax planning. Okay. That's the long-term. And this is replicable because every single year, I'm going to get this extra cash flow that I'm not paying tax on today. And so, yeah, I have this tax loss and it'd be cool if I can claim the tax loss, but I've reduced my effective tax rate by 13 points over the span of a decade. That is significant. And that will help you snowball that wealth. This is what I try to lock all of our clients into and help them see. And so then our tax planning becomes a little bit of what do we do to optimize immediately and get a refund immediately? But at the same time, let's not let the short run decisions outweigh the long-term strategy of how do we build a real estate portfolio that we don't pay tax on the income. And you can lever this up with passive activity netting, which I'll talk about in 1 second. So how does the 1% use the tax code? Passive activity netting, qualify as real estate pro, short-term rentals, investing in oil and gas, the BRRRR strategy, swap until you drop. We're not going to go through all of these, but we'll probably go through 1 through 3. Number 4, invest in oil and gas. I'm kind of on the fence on that one. We've had some clients invest in oil and gas syndicates and do pretty well. The tax benefit of investing in oil and gas is if you take a working interest in an oil and gas syndicate, you can deduct the cost, a large percentage of your investment. You can immediately deduct on Schedule C. So if I put like $100,000 in, I can get like an $80,000 tax write-off on Schedule C and directly offsets my W-2 income. And that's only for working interest positions. The problem is that I still invested $100,000 into an oil and gas syndicate, which is highly risky. Okay. We've only seen a handful of clients actually pay out from that type of an investment. So it's the equivalent of like giving $100K to charity almost and being surprised with a return one day. That's the way that I like to think about it, which is also why I'm on the fence. But I put it on here nonetheless because it is something that our clients like to do and get a tax refund for. The BRRRR strategy, that's buy, rehab, rent, refinance, repeat over and over and over. Not like your traditional tax strategy, but it's a highly effective tax strategy. because you're recycling the cash via debt financing. So whenever you buy a property, 100% cash, you rehab it, you rent it out, you get the higher valuation, you force the appreciation, then you get the loan, and the loan cashes you out of the position. But the cash that you receive from the loan is not taxable. It's not a taxable transaction. Whenever you put debt on a property, or whenever you do a cash out refinance, not a taxable position. So you're getting cash that you get to go redeploy, and you can do this over and over and over and over and over, and literally never pay tax on your portfolio, but be able to play the money shell game of moving the equity to the next property, to the next property, to the next property. One of my partners, Taylor Brugna, did this really well. He started in 2013, I believe, with a little condo, and then he rolled that into a duplex, and then he kept rolling. And today he's got like 190 units or something like that. And the guy, I think he's like 32 years old, and it's incredible. He's got an incredible growth story. So, and we have in our client base a lot of real life examples of this as well. But again, what is this? It's a long-term strategy. Taylor didn't start with 190 units. He started with one in 2013, and it took him 11 years to get here. But now he's got a portfolio that's kicking out so much cash that sometimes I'm like, why are you even working, Taylor? Like, what are you doing? Like, don't get me wrong. I love you. And I love all the work you do for the firm, but like, man, like you gotta kind of look at this. What are you doing? But anyway, like real life story, but again, decades, right? We're thinking long-term. So BRRRR is great. And then swap until you drop. And I'm skipping ahead because I don't want to hit all those different slides, but swap until you drop is 1031 exchange until you die. And then your kids get a stepped up basis in all of your assets. So a lot of times people will say, well, you have to pay depreciation recapture tax whenever you sell the property that you've taken depreciation on, which is totally true. But you don't actually have to sell, right? Life's all about options. I don't have to sell. And a lot of people try to liquidate their portfolio before they die because their kids don't want to deal with it. But that liquidation of those assets, especially after 3-4 decades of accumulation, is so incredibly expensive for the taxpayer before they pass away. And so there's this analysis of like, well, do we do it before? Do we do it after? Where's the estate tax come into play? But swap until you drop is great because you just 1031 until you die. And then your kids get a stepped up basis in the asset. All that depreciation recapture tax is eliminated. All the gain is eliminated. They can sell your entire portfolio tomorrow and pay $0 in taxes. Actually, they'll probably have a loss when they sell your portfolio right after the date of your death because you get to deduct selling expenses as part of calculating the gain or the loss on sale. So kind of cool. Or they can just rent it out and restart that whole depreciation process again. So swap until drop, very powerful. And the 1031 exchange too, something I always like to mention is you don't always have to do a traditional 1031 exchange. There's something that we call the lazy man 1031, which is effectively a 1031 without doing a 1031. So what happens is you buy and sell a property in the same calendar year. And as long as you do that, then you can effectively do a 1031 exchange. So if I sell a property for $100K gain, and then I buy a new property worth $500K, I can cost seg the new property and I can get a $100,000 deduction from that cost seg, and that offsets the $100K gain on the property that liquidated. Okay, so it's the same impact of a 1031 exchange because my replacement property, the basis is now $100K lower because I took all that depreciation. That's the same effect of a 1031 exchange. You're just rolling forward your basis, right? But the beautiful thing about a lazy man 1031 is that I can also do this with LP investments. So you can't 1031 exchange LP investments because when you are an LP investor or you own a partnership stake in any partnership, whether it's GP or LP, you own the paper, which is an intangible asset. You don't actually own the underlying asset that the partnership owns. And you can't 1031 exchange paper. You can only 1031 exchange real property. So if I'm an LP investor in a fund or a syndicate and that syndicate liquidates, I cannot 1031 exchange that position. I can't roll forward the gain unless I do the lazy man 1031, right? Same concept. Syndication liquidates, gives me a $100K gain. I put 120K into a new syndication and I get a $100,000 deduction. They net out. Same impact. And now in the new syndication, my basis is 20K, right? So I've just rolled forward the gain, essentially. That's how the lazy man 1031 exchange works. The caveat is that it just has to be in the same calendar year, but there's no timing requirements, right? I could place the syndication investment, the new syndication investment on January 1st of 2025. And the old syndication that I'm already invested in, they liquidate and they give me the check on December 31st, 2025, right? So a whole year went by, but it's still in the same calendar year, so they can still net out. Does that make sense? Great. All right. I'm going to jump into passive activity netting, qualifying as real estate pro, short-term rentals. But I first want to talk about what is a passive activity, because that's kind of the foundation for the next few slides. All right. So what is a passive activity? In 1986, Congress implemented the passive activity loss rules, section 469 of the Internal Revenue Code. Before 1986, you could be a landlord, or you could be a rich person making a lot of money, and then you could decide to be a landlord, buy a bunch of rental properties, and use the depreciation to offset your income. No ifs, ands, or buts about it. Really simple, really straightforward. I was not alive in 1986, so I can only imagine what the protests were like, right? Like the Occupy Wall Street stuff, Occupy landlords. Something caused Congress to say, this is not fair that the super rich people get to use depreciation from rental real estate to offset their regular income. So they implemented Section 469. So Section 469 was implemented to stop rich people from investing in real estate and using the depreciation to offset their regular income. I think that's a really important frame for everybody to understand if you have any interest in claiming real estate professional status or the short-term rental loophole. Because these rules were implemented to prevent you from doing that, right? And so you have to understand that if you're going to do these things, your documentation needs to be bulletproof, because the IRS does not want you to do these things. Congress does not want you to do these things. They want their tax money. Now, you can do these things. They are legal, but they were implemented to stop you from doing it. And they will try to prevent you from doing it if you mess up even an inch. So really important to understand kind of the history there and the intention, so that if you decide to go this route, you nail it every time. This is not if real estate professional status, short-term rental loophole is not for somebody that stinks at documentation and admin work or delegation to an admin. You need to be, you have to take that super, super seriously. As we have been finding out this year with audits that are coming inbound from other accountants. Okay, so what is a passive activity? So Section 469, when it was implemented, what it did is it created two buckets of income, passive and non-passive, okay? In the passive bucket is all of my rental real estate, unless I qualify as a real estate pro, and any trade or business that I do not materially participate in. So if I invest $100,000 in my local hair salon, they go, Brandon, you don't know how to cut hair, you don't know how to operate a hair salon, we just want your money, but we don't want you, right? Just your money. I get a stake in their company for my $100,000 investment, and I don't get to do anything. I'm not operating. I'm not voting. I'm not making decisions. They pass me $10,000 a year back profit, right? That is passive income. So that goes into my passive bucket. And we'll talk about passive activity netting here in a second. So all rental real estate and any trade or business that I do not materially participate in. I'm not materially participating in that hair salon because I'm not making decisions and I'm not part of operations. So it's going into the passive bucket. The other bucket's non-passive income, and that is literally all other income. Okay. So don't think about like ordinary versus portfolio and all that stuff. That's a separate set of regulations. What we're talking about now are just two buckets: passive, non-passive, rentals and hair salon investments that I don't materially participate in, and literally everything else. And when I say literally everything else, I mean literally everything else. It's my retirement income if I'm cashing out retirements. It's my W-2 income. It's my business income where I do materially participate. So my CPA firm income goes into the non-passive bucket. It's interest income. Weird, I know, but these rules are written in a weird way, right? So interest income is considered not from a passive activity, goes into my non-passive bucket. Dividends, same thing. Capital gain on stock sales, same thing, right? So essentially nothing is allowed to be offset by rentals. But with one caveat of passive activity netting. But that's the point, all right? So they separated it all out. Now, if you qualify for an exception to the passive activity loss rules, that's when you're jumping your rentals out of the passive bucket and putting them into the non-passive bucket. And now you can use the losses to offset your income. And the exceptions to the passive activity loss rules that do that jump, that's real estate professional status and short-term rental loophole. All right. And there's a couple others in there, but we're not going to go over those today. So primarily real estate professional status, short-term rental loophole. That's why people want to get those statuses, because when they are able to qualify, they move their rentals to the non-passive bucket. And now any loss generated by the rentals can directly offset their W-2 income, their retirement income, their business income, their interest, dividends, capital gains, all that stuff. If you can't make that jump, so if your rentals are passive and they get stuck in the passive bucket, the losses get suspended and carried forward until you create passive income in the future that can offset them, or until you sell a rental at a gain. So that's just kind of how the fundamentals of that work. Let's keep going. Let's talk about what passive activity netting is. So this is something that is not sexy, but is the long-term kind of end game on steroids sort of strategy. Like, this is an amazing strategy if you can nail it. Now, why I love it is because this is for lazy people, and I know that I run a business and I grow my business very fast, and I'm locked in, rock solid, ready to rock and roll. But we have a joke internally where I actually I have this like thing where I think the most lazy people actually figure out how to scale the biggest businesses and portfolios because they don't want to do any of the work, which actually enables other people that are really qualified to step in and do all the work. And that's kind of been my growth story. So it's, it's fun, but this is for lazy people. Okay. And the reason it's for lazy people is if you can think a little bit more strategically and a little bit longer term about how to structure your portfolio, you can actually get everything offsetting each other without having to jump through the hoops of real estate professional status and the short-term rental loophole. So you can create some significant tax savings, which just increases that wealth snowball without having to lift a finger, aside from underwriting all these deals and, obviously maintaining them. But you don't have to actually put in the work. You can have professional property managers manage everything. So the idea with passive activity netting is just that passive losses offset passive income. Okay. So rentals, we just kind of talked about that. Rentals are automatically passive unless you qualify as a real estate pro. But real estate professional status is a lot of work, man. 750 hours, more time in real estate than anywhere else. Who wants to really do that, right? So we don't want to do that, right? So our rentals are going to be passive. Now, the rentals typically produce passive losses thanks to depreciation, even when they produce positive cash flow. I kind of gave you an example towards the beginning of this presentation as to how that works. So I can have a rental producing $10,000 of income, but it's got $12,000 of depreciation, so $2,000 tax loss. But the problem is that loss is suspended and carried forward. It's passive and then suspended. Over time, if I can figure out how to create passive income, then I can have these passive losses that I can't use. So the losses in excess of my rental income. I'm already getting my rental income tax-free or tax deferred. But this excess loss that gets suspended, man, it'd be great if I could figure out a way to tap into that. And that is where creating these passive income sources comes into play. Because if I've got, let's say like on my own tax returns, for example, I have about $100,000 of suspended passive losses that just keep accumulating year after year after year. I can go and create a passive income stream, and I will not pay tax on the first $100,000 that passive income stream gives me, if I can think a little bit more strategically about building my portfolio. So what creates the passive income? There's two main things. One are businesses that I don't materially participate in. Okay. So that hair salon example, great example. I put $100,000 into hair salon. They give me $10,000 a year back. I can get $10,000 a year for 10 years and pay zero taxes on that income stream. That is powerful, right? I can also invest in a venture fund. I can invest like the syndications and the real estate funds that we have. Same thing happens in small business, right? There are people that put together capital to go and acquire HVAC companies and plumbing companies and CPA firms and just all sorts of companies. Well, if you have a stake in that fund, you are a passive participant in that fund, and the income that you receive back is passive income. So if you have passive losses from your rental real estate, another source, another way to generate passive income is to invest in businesses, either directly or indirectly. The second way to create passive income is to run that short-term rental loophole that everybody talks about. But the first year you actually run the loophole. So you materially participate in the rental, you run the cost seg, you strip out all that depreciation, you get the big tax loss, you offset your income. The second year that you own the short-term rental, you hand it over to a property manager and you make it passive. Why would you continue? I wouldn't continue materially participating unless you just like love hospitality, which is a really hard business. But if you love it, you're great. You keep doing it. However, if you're a lazy person like me, you hand over the short-term rental to a property manager in the second year, and now it's a passive rental for you. But what happened was I already stripped out all the depreciation in year one. And because I did that, there's not that much depreciation in future years to offset the income. And short-term rentals like scream, right? I mean, if you bought in a good area and you underwrote it well and you're half decent at hospitality, you're going to crush it with your short-term rental on an ongoing basis. And so, and there's typically not enough depreciation to offset the cash flow. So the cash flow coming from that short-term rental is passive. Passive income can be offset by passive losses. So you can build your own kind of like offsetting portfolio, and you can just scale that up and never have to worry about qualifying as a real estate pro or running the short-term rental loophole year after year after year. All you have to do is build a few short-term rentals out that produce enough cash flow to give you 5 years of buying long-term rentals that will produce tax losses year after year after year. Very powerful, because you don't have to materially participate. You don't have to lift a finger, but you're getting all this cash flow and you're not paying taxes on it today. You're just kicking the can down the road. Again, longer term strategy though, right? So that's kind of going all the way back to, I'm still paying that $225,000 on taxes on my $500K W-2 income. And if that bothers you, then by all means, like, let's figure out how to knock that down. But the idea is that I create an additional $200K of cash flow that I pay zero taxes on. That is passive activity netting. And it took me 7 minutes to explain that. And that's why you don't see a whole lot of that on social media, because it's just not as sexy. This is the end game though. This is like our most successful clients. This is what they do. Our most successful clients. We have a client that is almost a billionaire. This is what he does, right? So the key is just to understand that I can do the gimmicky stuff in the first year or in the short run, but long run, this is the golden ticket. This is what I should be aiming for long run. Passive activity netting, passive sources that just net out against each other, offset each other. I've been talking about real estate professional status, so I do want to touch on that, and then we'll touch on the short-term rental loophole, and then we'll wrap up and get questions. So, real estate professional status. The passive activity loss rules say, again, all rentals are passive unless you qualify as a real estate professional. So, real estate professional status, to qualify, you have to spend 750 hours and more time in real property trades or businesses than you do anywhere else. So those are the two rules: 750 hours and more time in real estate than anywhere else. So if you work a full-time job, you're automatically out. You can't qualify as a real estate pro, because you're not going to be able to justify that you spend more time working in real estate than you do at your W-2 job. The IRS will just never buy it, and neither will a tax court. And many people have tried, and every single person has lost. But if you can show that you spend 750 hours and more time in real estate, then you are a real estate professional. And as long as you materially participate in your rentals are now non-passive. So they jump out of the passive bucket and they jump into the non-passive bucket, which is where all of your other regular income is. And now you can run cost segs, increase the depreciation, increase the tax loss, and offset all of your regular income. So that's why everybody wants to be a real estate professional, is to make that jump happen to the non-passive status, run the cost seg, get the big tax loss, and enjoy my tax savings. Now, if you work a full-time job, but your spouse does not, then your spouse can qualify as a real estate pro. And as long as you file a joint tax return, you have a real estate professional status tax return. And the cool thing about material participation, so that's the second kind of layer to this. Layer one's real estate pro, layer two's material participation. The cool thing about material participation is that you can combine spouse time in the activity. So if my wife and I are managing a rental portfolio together, and she's a real estate professional and I'm not, if I'm doing any repairs or management or anything, I can still count that time towards our collective material participation hour tests. There's 7 tests for material participation. The 3 that we see most often completed are 500 hours spent on the activity, 100 hours and more than anyone else. So you have to outwork everybody, or substantially all your time. So my participation is substantially all the participation in the activity, which means that nobody else did anything except for me and my wife. That is essentially how those 3 tests work. So if my wife spends 200 hours managing the rentals and I spend 301 hours managing the rentals, even if I'm not a real estate professional, if she's a real estate professional, we have real estate professional status, and collectively we also have material participation. Real estate professional status has to be achieved by one spouse completely on their own. So you cannot combine time for the purposes of testing real estate professional status. But where this is powerful is if my spouse is like a real estate agent or a broker or or in construction or wholesaling or whatever, property manager, not directly related to rentals, but like running a real estate business, they can qualify as a real estate pro just in the real estate business. Like if she's an agent and she's showing properties all day long, she's a real estate pro. And maybe she hates the rentals, right? But I like the rentals. So she's a real estate pro. I do all the material participation. Combined, we have real estate professional status and material participation hit. So it's really powerful when you kind of like divvy up the job duties. So just something to think about there with real estate professional status. The short-term rental loophole. So back in I don't know if many people know this, but back in 2020, we had I saw somebody raise your hand. Feel free to jump and ask questions in the Q&A, by the way. I will get to that here in probably 3 minutes, 5 minutes. Back in 2020, I had a lot. There was a couple groups that were sending me a ton of clients, but they had told these prospective clients that they could all qualify as a real estate professional, but they all worked full-time jobs, right? So they sent them to me and I'm like, yeah, you work a full-time job. You can't qualify as a real estate pro. And then they went and there were like a couple other CPAs there. And one of the CPAs was like, yeah, we'll do it. That's fine. No big deal. Big red flag, by the way, which they're now finding out with all the audits, but that's beside the point. So I was like, no, you can't qualify. And I finally got so like just frustrated with having to be the bearer of bad news on all of these calls that I ended up writing like a 32,000 word, or sorry, a 20,000. I don't actually know how many words it was, but it was a really large guide on real estate professional status, 32-page ebook that can be downloaded still on our website today, therealstatecpa.com. But if you look up like real estate professional status, the ultimate guide to real estate professional status, that's the guide. And it's fully cited. So I wrote down everything top to bottom, all the tax court cases, all the regulations, all the Internal Revenue Code sites. I wrote down, here's how the IRS audits you. Here's how to be prepared. Here's the questions they're going to ask, which they give you all that information. They have the IRS has audit technique guides. That's essentially like a playbook for how they audit people. And they have one specific to passive activity loss rules, which is primarily real estate professional status. And they have all the questions in there, all pre-scripted out. So you can literally go and read it and prepare yourself for an audit. And that's actually how we do a lot of our tax planning around real estate professional status, is basing it in first understanding the guide and then making sure that we build it so that we meet all those qualifications and the questions that they're going to ask. Beside the point. The point, though, is that as I was going through and building this very extensive guide out, because I was just so frustrated, and I finally just started sending it to everybody, like, you just read this. As I was doing that, I stumbled across the regulations in Section 469 that define what a rental activity is not. And the regulations say a rental activity, you do not have a rental activity if you meet bullet point number 1 or 2 there. And there's a few other bullet points too. But if your average period of customer use is 7 days or less, you do not have a rental activity. The significance of that is that real estate professional status applies solely to rental activities. And the significance of that is real estate professional status is the status where one of the tests is to spend more time in real estate than anywhere else. So if I don't have to qualify as a real estate pro because I have a short-term rental where my average period of customer use is 7 days or less, then I also don't have to worry about spending more time in real estate than I do anywhere else. So I can buy short-term rentals while running a business, while working a job full-time, and all I have to do is materially participate. And as long as I materially participate in that short-term rental, it's non-passive because it's not a rental activity. And real estate professional status only applies to rental activities. And real estate professional status is the one that has that test of spend more time in real estate than anywhere else. So pretty big aha moment, right? I was like, holy crap, I just stumbled across something that's amazing. I started doing some research. I was like, who else knows about this? Nobody else knew about it except for one site, one publication called Bradford Tax Institute. They're great. They really break things down too. Like if you're ever interested in like learning about tax, go check them out. But they talked about it, I think, on like one web page. And so I was like, holy crap, this is amazing. So we ended up spinning up a bunch of podcasts. We did a ton of content, and now you see it everywhere. Like people, like I truly believe we were the godfathers of this, of at least bringing it to market. And now it's like kind of actually crazy where we've started like fighting against it because I think people are making bad decisions and taking undue risk. And that was not the original intent, but a very cool loophole because you can buy real estate that's not considered a rental activity, even though you're renting it out. And you don't have to like jump through the hoops of real estate professional status. You do have to materially participate. You have to meet one of those 7 tests. Again, 500 hours, 100 hours or more than anyone else. and or, these are all ors. You only have to beat one test, not all of them, just one. Or my time is substantially all the time that anybody spends. Now, most of our clients try to hit that 100 hours and more than anyone else test. The risk is that if you don't track everybody else's time, your cleaner time, your repairman time, property manager, if you have one, their time, then the tax court will not buy the fact that you outworked everyone else. They might agree that you spend at least 100 hours, but they're not going to agree that you outworked everyone else. You spent more time than anyone else unless you can prove how much time everyone else spent. So the administrative burden of the short-term rental loophole, if you're trying to hit that 100 hours and more than anyone else, which most people do, is that you have to figure out how to track all of your vendors' time. There was a tax court case, Lucero versus Commissioner, back in 2020 that came out, and that was their issue. Tax court denied them the deduction because they could not prove that there were some other issues with their time log, but the tax court opined on it, and they were like, even if there were no issues, you did not provide any time that your contractors, your vendors spent managing a property. Therefore, we have no way to tell if you actually spent more time than them. Therefore, you lose. So it was a really interesting case. It just kind of reinforces this fact of, taxes is half strategy, half documentation, and you better be darn good at that documentation. So that's the short-term rental loophole. That's why everybody's jumping on it, is because it's a little cheat sheet to get real estate exposure, get the tax losses, offset your income without having to qualify as a real estate pro. If you qualify as a real estate pro, or if you run the short-term rental loophole, the one thing that I want you to double check with your accountant on is something called excess business loss limitations. So we've had people come into the firm, clients coming inbound to the firm that have already run this. They already did the cost seg. They've got $1 million tax deduction, but the excess business loss limitations cap them at like $560K or something like that. So make sure that you check with your accountant on whether or not you are exposed or subject to the excess business loss limitations, and make sure that you really clearly understand what those limits are before you start paying for a bunch of cost segs, because we don't want you to be disappointed later. That is that's it.
I hope you guys took away a lot of golden nuggets. Brandon talked about rep status, bonus depreciation, likely going back to 100%, which I certainly hope so, and so much more. Brandon can be found at therealestatecpa.com. This is Gary Lipsky signing off. I'll be back next week with another informative episode on the Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.